Did you know you could reduce your tax bill by strategically selling investments that have lost value? It's called tax loss harvesting, and it's a powerful tool to help you minimize your tax burden while keeping your investment strategy intact. Today, we're diving into what tax loss harvesting is, how it works, and how you can use it to your advantage. Welcome to Factful Finance, the place where we break down the complex world of money in a way that makes sense. I'm so glad you're here today, and if you're looking to grow your wealth while keeping your taxes in check, you're in the right place. So what is tax loss harvesting? Simply put, tax loss harvesting involves selling an investment that has decreased in value to offset gains you've made elsewhere in your portfolio. This strategy is most often used with taxable investment accounts, and it's a legal way to reduce your taxable income. Let's break it down with an example. Meet Liam. Liam has a diversified portfolio with a mix of stocks and bonds. Over the year, his stocks have done really well, but one of his tech investments took a bit of a hit. Instead of just holding on to that losing stock, Liam decides to sell it. By doing this, he realizes a capital loss. Now, instead of paying taxes on his gains from the successful stocks, he can offset those gains with the loss from the tech stock. But here's the catch. It's not just about selling to get rid of losers. You need to make sure you're following the IRS rules. When you sell a stock at a loss, you can use that loss to offset up to $3,000 of ordinary income in a given year. If you have more losses than that, you can carry them over to future years. It sounds like a strategy only for the rich or sophisticated investors, right? Well, think again. Even if you're just starting out, tax loss harvesting can be an essential part of your strategy. Here's why. It's all about making the most of your money by reducing taxes, which helps you keep more of what you earn. Now let's address the elephant in the room. What happens if you want to buy back that stock? This is where the wash sale rule comes in. If you sell a stock to realize a loss, the IRS says you can't buy the same or a substantially identical stock within 30 days of selling it. If you do, it will be considered a wash sale, and you won't be able to claim the loss on your taxes. So make sure to plan accordingly. You can buy a similar stock or wait the 30 days, but just don't make that mistake. Let's bring this into a real-world scenario. Olivia has been investing in a few high-growth stocks, and some of them have done really well. However, one of her investments in a new biotech company has dropped in value. By selling that position, she realizes a loss and uses it to offset her other gains. Now, instead of paying taxes on her successful investments, she has reduced her taxable income, all while keeping her portfolio intact and ready for the next opportunity. This strategy can be particularly powerful in a year when you have significant gains. For instance, if you sold an investment property or had a large capital gain from stocks, tax loss harvesting could help you reduce the amount you owe come tax season. Before you rush off and start selling, remember, tax loss harvesting is a tool, not a strategy for everyone. It works best for investors who have taxable accounts, and it's most beneficial when you have capital gains to offset. Also, keep in mind that you need to weigh the tax benefits against your long-term investment goals. Selling a stock at a loss may save you some money on taxes, but it could also mean giving up on a good investment that has the potential to recover. Always keep the bigger picture in mind. Now, let's talk about what you can do next. If you're considering tax loss harvesting, here are some actionable steps. 1. Review your portfolio. Take a look at your investments and see if there are any positions that are underperforming. 2. Assess your gains. Figure out how much you've earned in other investments this year. If you've made significant gains, this could be the time to offset them. 3. Consult a professional. Tax loss harvesting can get complex, especially when you have multiple accounts and investments. It's always a good idea to consult with a tax advisor or financial planner to make sure you're taking full advantage of this strategy. Remember, this content is for educational purposes only. The apps or tools I mention are not endorsements, and it's essential to consult a professional for personalized advice tailored to your unique financial situation. Tax loss harvesting can be a game changer if used correctly. By strategically offsetting gains with losses, you can reduce your tax bill and keep more of your hard-earned money working for you. But as with any strategy, make sure to use it wisely and in line with your overall financial goals. What do you think? Are you planning to use tax loss harvesting to your advantage this year? Let us know in the comments below. If you found this video helpful, why not hit the like button and subscribe so you don't miss out on more valuable tips to keep your finances on track. We think you'll find the next video on screen equally helpful in your journey to financial success. Thanks for watching Factful Finance. Until next time, take control of your financial future.